Welcome to another course by Auronum, in which we will be discussing the Brown's Bottom, the controversial sale of Great Britain's gold. This course is going to be a really interesting one and a good presentation of evidence for both sides of the fence as to whether you believe this was done through manipulation or for other reasons. And I think that a lot of students that are aware of Brown's Bottom will probably change their mind once they've seen the evidence in this lesson as to what actually went on at that time. So in a nutshell, Brown's Bottom is when the Labour Party sold off around half of the UK's gold reserves, and it's called Brown because Gordon Brown was the Chancellor at the time who made the decision to sell. The sale couldn't have really happened at a worse time. The gold price was at a multi-decade low and just before a 10-year bull market. Many people believe that the UK sold her gold reserves to depress the price of gold because there were some bullion banks that was excessively short and exposed to a rise in gold price. The reason why this sale is so controversial is because the UK announced the sale before they started to sell into the market, so they made the whole market aware that they was going to be a big seller in the market. The sale occurred pretty much at the bottom of the market, so it couldn't have happened at a worse time. And 40% of the proceeds were invested in euro denominated assets, and the euro was quite new at the time, and so this is seen as a political move. And also, as mentioned, many people that are quite reputable in the industry believe that the UK sold off the gold reserves to deliberately depress the price of gold to let off some bullion banks that were excessively short. So for anyone that has actually researched the Brown's Bottom, you probably get figures different to what you're seeing on screen right now, because there's lots of different sources that quote different amounts of tons that were sold, but this is actually from HM Treasury. There was 395 tons of gold that was sold, and the sale was announced in Parliament on the 7th of May 1999. You'll see on the chart that follows in one of the other slides is that gold immediately fell $9 or just under $10 per ounce, which was quite a lot at the time. This is a chart for the gold spot price at the time of the gold sale announcement, and you can see that the arrow pointing down, that was a big down day for the gold price, and that was the day that the UK announced this gold sale. And you can see that the gold price sold off immediately on the day and then went down in a very aggressive bear market for several months. There wasn't much upside in the gold price for some time after that announcement. And just for interest as well, the second arrow that you'll see, that was when several central banks agreed that they would cap the amount of gold that they would sell within any year, and that was a 5-year agreement which was renewed several times afterwards. But you can see the effect that it had on the gold spot price. This chart is excellent for illustrating how bad the timing of the gold sale was. Each of the red dots are the auctions, and you can see that the first one took place in early July 1999, right at the bottom of the market. But it was only 2 auctions that occurred at that time. The rest occurred at a higher gold spot price. But if you go to the furthest one to the right, that was in March 2002. And that final auction where the final amount was sold was just at the beginning of a bull market, and that gold bull market lasted around a decade. It started around 2001, and by then UK had already sold most of its holdings that it wanted to sell at the time. On this slide you'll see some unofficial calculations that I've done. If you Google how many ounces in a ton, you will get a different figure to the one that you're seeing on screen, but this is actually quoted from the Treasury, the UK Treasury, and you can see that the UK sold off 395 tons, and that is about 12.7 million ounces. On the day that the gold price sale was announced, gold was trading at $288 per ounce. The UK, by its own admission, achieved around a $275 per ounce price. That is a delta or a differential of around 165 million US dollars. So if the UK would have just sold at $288 per ounce instead of announcing it and pushing the gold price lower, they would have been better off, more in the money, by the magnitude of 165 million US dollars. Now this is hypothetical because I don't think that you would be able to unload that amount of gold in one day, but it shows you that the effect that the pre-announcing of the sale had on the realized price that the UK actually achieved for its gold sales. The question that a lot of people will want answered was the whole selling of half of the UK's gold reserves just an exercise to drive down the price of gold because of a bullion bank or two being excessively short? And a lot of people believe that this is the case because of the way that the UK announced the sale in advance and then sold off such a big holding at a really bad time. And there is some merit to this argument, because if the UK government believed that some of the banks in the bullion industry were so heavily short and out of the money on that short position that they could become insolvent if they had to close out at the current price, they might fear a contagion risk, which is basically where the banks that are heavily short and losing a lot of money on that position, if they become insolvent, they have to sell off their assets, or their creditors will do that on their behalf, and that will cause the collateral on other bullion banks and other financial institutions to go down. And it's like a domino effect. If you don't bail out the bad banks, then they can pull down the good banks with them, and then the whole system goes under. So there is some merit into thinking that the UK government would want to avoid that and bail out some of these banks that was in a really bad position. What we must question is, why would the bullion banks be excessively short? A lot of people I've heard on interviews discussing this say that they are excessively short because they want to manipulate the gold price. I don't believe that's the case. I think it's down to the gold carry trade, because conditions in the 1990s was absolutely ripe for the gold carry trade. And it's possible that there was bullion banks that had big carry trade positions on in gold and was exposed to a rise in the gold price. And basically what a gold carry trade is that it's when an institution such as a bullion bank, they borrow gold from a central bank in return for an interest payment. And then what they do is they immediately go and sell that gold and invest it in a higher yielding asset. And their profit is the differential between what they are paying in interest to the central bank to borrow that gold and what they are earning on the higher yielding asset. The issue with a gold carry trade is that they've borrowed that gold, so they need to repay it. So once they've borrowed the gold from the central bank, sold it, invested the proceeds into, let's say, Australian or US Treasury bonds, they then liquidate that position at a profit. Then they have to go back to market and buy the same amount of gold that they owe the central bank and then pay it back to that bank plus the interest. If the gold price has risen in that period, then that eats into their profit. And if the gold price spikes, then they still have to, they are liable for that amount of gold. So they have to buy it no matter what the price is. They have to buy that gold back because they owe it back to the central bank. And that is where they are so exposed to a rising gold price. And because of this exposure to a rising gold price, the gold price was falling for years before the 1990s. So there wasn't really that much of a risk in, or a perceived risk in, the gold price spiking because it was just in a bear market. So this actually increased the profitability of the gold carry trade, because when the institution borrowed from the central bank and then they invested the proceeds elsewhere, when they had to buy that gold back, when you're in a bear market, there's a good chance that you'll actually buy the gold back for less than what you sold it. So not only did you make money on the investment that you used from the gold proceeds, but you also make more money because you buy the gold back for less than what you paid for it. And this is why conditions were ripe in the 1990s for the gold carry trade. And that's why I believe that if there was bullion banks that were excessively short, it was because they were using the gold carry trade at the time. Two of the main rumours that came out of the Browns bottom sale is that some of the central banks had to agree as part of the bailout package that they would leave the LMBA. Secondly, many people believe that the whole sale was politically motivated because the UK there was a point where people believed that the UK was going to ditch the pound sterling and join the euro. Thankfully, that never happened, but the gold sale could have been to be seen so that the UK was supporting the euro, because it said we're going to sell half of our gold and 40% of the proceeds will be invested in euro denominated assets. And although this is not proof that a bullion bank left because it was bailed out, I found a Reuters report saying IAG International Limited actually left the LMBA, which is the London Bullion Market Association, in 2004. So maybe this is just coincidence, but this is 2 years after the last auction. The IAG International Limited, which was a massive member of the LMBA at the time, they completely left the market. This is where the whole theory of the UK government bailing out bullion banks because they was excessively short in a rising gold price environment is just inconsistent, because the UK announced the sale in early May 1999. The central bank's gold sale cap was announced September of the same year. That was, you saw on the map in the previous slide, that was an event that sent the gold price spiking. And in one of the other events that really started to change the dynamics of this bear market and turn it into a bull market was the terrorist attack in September 2001. So the UK government actually announced that they was going to make all these sales before the gold price really started to go up, which is inconsistent, because you would expect that the gold price would be going up and then the UK government announced the sales, but that wasn't the case. So this is inconsistent with what a lot of people believe. This statement was taken from an interview of the ex-Chancellor Philip Hammond. He's a Conservative Party ex-Chancellor. And what you'll see in this is he sort of hints that he believes that the sale may have been politically motivated, but also makes explicit that 40% of the proceeds went into euro-denominated assets, and said that Blair, which was the PM at the time, was pro-euro. But you'll see very shortly that he's only giving you half of the story, and when you get the full picture, suddenly things don't seem as much of a conspiracy theory as you'd think. When you look at the full picture behind this sale, it actually kind of made sense at the time. It just happened at a really bad time in the market. The proceeds of each auction were invested in foreign government bonds. And it's true that 40% was invested in euro-denominated assets, but what they don't tell you is 40% was invested in US dollar-denominated assets and 20% in Japanese yen. And when you come to think about it, if you think of the UK, the main trading partners are the Eurozone and the US. So we effectively sold off a non-yielding asset and invested it into interest-bearing assets of our main trading partners. That makes sense, surely. And the motivation as to why they wanted to reduce the amount of net foreign currency reserves from 50% of that being gold to just 20% was they believed that there was way too much exposure to a single asset. And I think anyone would feel that way. If you had your own investment portfolio, 50% in one asset, you might feel a little bit uncomfortable, because every time that asset moves, your net worth is really swinging around. And this is in line with the optimal portfolio analysis that the UK government done at the time. And they said that to reduce the risk of the taxpayers' investments, what they should do is to reduce the gold position down to 20% of our foreign reserves. And so the government's own argument for the gold sale was diversification. What they wanted to do was to reduce the amount of holdings in gold and invest that in a foreign currency asset to reduce the overall risk of the portfolio so that it's not so overexposed to a single asset. What a lot of people cannot look beyond when it comes to this conspiracy that this was a big bailout for bullion banks is that the sale was pre-announced, which is a very strange thing to do when you are trying to sell in a market such as gold and you are going to sell 395 tons of it, because it allows for front running. If you have any asset and you get wind that there's going to be a big seller of that asset and you own some of that asset, you can sell it immediately before the big seller comes in, and you are pretty much assured of a better price than they will get, because the selling will add to supply of the market. The big seller will add to supply of the market, which will push the price down. That allows you to front run, meaning you can sell before they sell and you get a better price for doing that. But the reason why the UK government announced the sale was they wanted transparency to attract buyers and also to reduce the risk premium in the market, because if they just started selling, the market might think, how much of their holdings are they going to sell? And they might start to put in a risk premium on the gold price, because they could think that the UK government is actually willing to sell more than it actually is. So by saying we are going to sell half of our gold reserves, it takes away the uncertainty, because the market then knows the exact amount that's going to be sold. But look at the table here. You can see that in the 1990s, the fact that the UK sold off half of its gold reserves, it wasn't unprecedented at the time. There was a lot of selling by Western central banks. Belgium actually sold more than the UK in this period. So you can see that central banks were sellers. This is not something that was really that unusual for the UK to come out and sell this amount of gold at the time. This quotation is taken directly from a document issued by the HM Treasury in October 2002, and in it they discuss the Switzerland National Bank also signalled their intention to sell part of the gold reserves in advance. So what the UK done in pre-alerting the market was not unprecedented. The Swiss had actually done the same thing. And a declassified document by the UK government in August 1999 shows that the Swiss authorities announced in 1997 they were planning to sell 1,300 tons of gold. So it makes the UK situation seem quite normal, because the Swiss have done it before. And also in the New York Times in summer '76, there was an article that showed that the IMF also done a similar thing where they pre-announced the gold sale. So again, this is evidence to say that actually this might not be manipulation. This might just be how governments were dealing with, or some governments were choosing to deal with, gold sales at the time. In summary, we know that the UK government was not alone in pre-alerting the market to a big gold sale, because we've seen that the IMF done it in the 70s and Switzerland done it at the late 90s as well. And the justification for the sale, which is diversification of the UK's foreign currency reserves, was actually quite plausible, because 50% of that was exposed to a single asset, which isn't very good risk management. It just so happened that they couldn't really have picked a worse time to diversify that asset. Many other Western central banks were sellers of gold at the same time that the UK did, so that isn't unprecedented. But this isn't really mentioned when you hear about Brown's Bottom. They don't say how many other central banks was actually offloading more gold than the UK did at the same period. And bailout of bullion banks was actually quite feasible, because the gold price was drifting lower in a bear market. So it actually made the gold carry trade very profitable, and conditions were perfect for that gold carry trade. So it's very plausible that bullion banks would have been caught short in a rising gold price market. But we know through the timeline that it's not consistent with the UK gold sale, because the gold sale was announced before the gold price started to go up. And don't forget that you can download for free a precious metal market report every week, which is updated, talking you through the developments of the gold, silver and platinum markets.